Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, July 9th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro events are Powell and Yellen testify to Congress and fresh evidence of our green shoots globally theme. In terms of market implications, Fed Chair Powell begins 2 days of testimony to Congress in which he will undoubtedly be grilled about the Fed's dual mandate and cajoled to provide clarity on how the Fed's reaction function is evolving amid recent evidence of a faster deterioration in asset markets. With respect to Yellen's testimony, investors should pay special attention to how the Biden administration plans to prepare for the lapse of the debt ceiling moratorium in January 2025. While the ongoing uptrend in Japan machine tool orders growth is supportive of the medium-term outlook for global growth, we do not believe asset markets will reward investors for betting on sustained European and Asian equity outperformance throughout the second half of 2024. As always, we'll wrap up with Transits Chart 42 Macro Dashboard here. As always, we'll wrap up with a question from our community. This one's regarding our July 6th around the horn. Not really a question, but I thought it was a great opportunity to expound upon and embellish our process a little bit. So this one reads, Saturday's around the horn was brilliant. I had moved to extreme safety / dividend / ultra low beta in a big way during the prior week. I'm delighted to see you make the move driven by the data with zero influence from commentary. As a retiree, this is why I subscribe to the product. Thanks for the excellent work, and thank you for the kind feedback. You know, I was just talking to one of my business partners just now about what we're doing here at 42 Macro, and what we're trying to do is change the way a lot of investors approach investing, because we ultimately think that there's a better way to invest than subjecting your portfolio and all the money that you have worked your entire life to save for your family to subjecting it to the significant left tail risk and significant volatility that asset markets have increasingly experienced. You know, there have been 7 crashes in the S&P 500 over the past 25 years. 7 not 25, 27 years if you go back to 1998. There have been 7 times you could have lost 20 to 60% of all the money you have worked your entire life to save. And what we're trying to do at 42 Macro is understand that, you know, through clever and institutional grade risk management frameworks, you can actually chop off that left tail of negative results so that you're compounding from a higher level of capital over time. And so it's not about the average return that you're experiencing. It's about the total amount of money that your portfolio is generating and the size of your portfolio as a function of compounding, which our friend Warren Buffett called the eighth wonder of the world. So you can compound at a faster rate from a smaller number, or you can compound at almost the same rate from a much larger number and wind up with much more money over a long period of time. And that's, without making any promises, obviously from a disclaimer standpoint, that's what our clients have been experiencing throughout, that's what our clients have been experiencing as clients of ours, since inception. And we're very proud of that. We boast that all of our clients, 100% of our clients can cancel anytime without penalty, anytime without penalty. Name one other firm in the entire investment industry that boasts such a lax cancellation policy. And the reason we have such a lax cancellation policy and such a thriving business is because we are doing on a daily basis what we purport to be doing for our clients, which is help them make and save a lot of money in asset markets, no strings attached. So I just wanted to say thank you for the client for the valuable feedback, because it does give us an opportunity to embellish what it is that we do. And just lastly, wrapping up in terms of embellishing what it is that we do for investors. So the commentary mentioned that we made the changes without the influence of, commentary or bloviation or whatever you guys are getting subjected to these days out there in the free finance podcast space. Two of the things that really drive our risk management process, one being our volatility adjusted momentum signal, and the other being our market regime nowcasting process, i.e. our global macro risk matrix. So I'll give you guys a real quick indication on how we're using these tools to help clients stay on the right side of market risk. So for example, this chart here, these charts here show the VAMS back test for the S&P 500 and for Bitcoin. And what you see in the bars are the cumulative performance by the VAMS conditions since January of 1998, or in Bitcoin's case, I want to say since summer of 2010 is when Bloomberg starts collecting the data for that asset class. And then in the dotted line plots, you see the percentage of cumulative performance by that VAMPS condition. So 76% of the S&P 500's cumulative performance since January of 1998 has come when our signal has been bullish from the perspective of a volatile adjusted momentum signal. Only 8% of the S&P 500's return has come when our signal is neutral, and 16% of the S&P 500's return has come when it was bearish, coming off of a crash low, one of those 7 crashes that we've observed over the past 27 years or so. The statistics are even more exaggerated in favor of why we're using the signal for Bitcoin and for the crypto market. 96% of Bitcoin's cumulative performance since the inception of the asset class has come when our volatility adjusted momentum signal has been bullish on Bitcoin. Only 6% has come when it's been neutral, and minus 2% has come when it's bearish. So obviously that means the Bitcoin has negative absolute returns when our volatility adjusted momentum signal is bearish. So just be aware that these tools, very powerful tools, are helping our clients stay on the right side of market risk by having created a rules-based systematic process that gives investors clear, actionable guidance on what they should be doing in their portfolio across a litany of assets as a function of changes in these signals, which tend to be relatively stable over long periods of time. And then lastly, I'll wrap up with our global macro risk matrix market regime back test, which is the models that are built that feed into our global macro risk matrix are our volatility adjusted momentum signals for 42 of the most important asset markets in the world. You can sort of see this here in this table here. We obviously summarize that with clear, actionable guidance for clients. We don't want to make them read a matrix table, but that guidance is obviously reserved for our clients inside of our paywall here at 42 Macro. So, but lastly, I'll just kind of wrap up and just show you that when you think about the world in regime space, the best benefit of thinking about the world in regime space is it creates clear, actionable signal in terms of the pivots you need to make in your portfolio to stay on the right side of market risk, without thinking about the world in regime segmentation terms, which Ray Dalio, the arbiter of the world's largest hedge fund in history, the person who invented regime segmentation, at least with respect to financial markets, the reason they do that is because it allows them to say, okay, now is the time to go. We have confidence in making this change, and making this change gives us a clear roadmap for the types of securities and assets that are likely to outperform and underperform based on our regime determination process. And so we can see this here in this back test where we show our risk on market regimes, Goldilocks and reflation, versus our risk off market regimes, inflation and deflation. And then we show that on a cumulative basis here in the chart on the right. So 78% of the S&P 500's performance since January of 1998 has come when our market regime nowcasting process has indicated we are in a risk on market regime, versus only 22% of the S&P 500's cumulative return since Jan 98 has come when we were in a risk off market regime. So the S&P does have some defensive characteristics and some defensive sectors that contribute to that performance. But by and large, you're generally going to want to be long stocks, and with a much higher Sharpe ratio, as you can see there in the dotted line plots. You're going to be long stocks and long risk assets when you're in a risk on market regime. And then lastly, if you look at the same back test statistics for Bitcoin, 112% of Bitcoin's cumulative performance has come since the inception of the asset class has come when Bitcoin has been in a risk on market regime, versus minus 12% when it's a risk off market regime. And as you can see, the Sharpe ratios are quite disparate as well. So that's all. It's a long-winded way of saying the system we do works. The system we use to help our clients stay on the right side of market risk works. The system we use to help our clients stay on the right side of market risk is different. It's orthogonal to what you're probably already doing out there, which is, generally speaking, in terms of how most investors manage risk, they are responding to failed predictions. How we manage risk is responding to Bayesian observations, much like you do when you're in your car and your Apple CarPlay says, got Google Maps on, it says, okay, turn left to beat the traffic. We're turning left to beat the traffic. Where most investors are unaware of that there's traffic generated because they have this medium to long-term investment thesis, which is fine. We're not saying you should not have medium to long-term investment theses. We certainly do. We help our clients anticipate regime change in our signals by formulating those medium to long-term investment theses. But where our process is orthogonal and different from what you're probably already doing, and why a lot of our clients are finding value in partnering with us, is because we don't respond to those medium to long-term views with changes in our portfolio. We only respond to change with changes in our portfolio to changes in signal, because that keeps us gives us the highest probability of staying on the right side of market risk, which in bull markets means maximizing upside capture, and in bear markets means minimizing downside capture. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, July 9th, 2024. I just want to say thank you for the client for the kind feedback, and thanks to all of our clients for generally kind feedback. You know, that just means we're doing exactly what we report to be doing for them, and we're very grateful for that. So we'll wrap it up there. Everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.